Hello, everyone, and welcome back to the Property Podcast Today show. As you know, I'm your host, Lee Dahill, and today with me, I've got Jeni on the show, the Business Development Director for Mortgage Finance Brokers. We're going to be talking about strategy, structure, portfolios, and how you can differentiate yourself with diversification. So before I do anything, as you know, I always get the guests to do introduction as to who they are, what they've been up to, and a little bit of background. And then I've got some questions set up for Jeni. So Jeni, over to you for an introduction.
Hi Lee, thanks for having me along. Really happy to be here. So I work as a business development director for mortgage finance brokers. So first of all, who are they? They're a whole of market mortgage brokerage. The lion's share of what we do is investment stuff, mainly on residential, but we also do commercial, semi-commercial development finance, and also we can do mortgages for people's homes as well. So basically, any type of first charge lending is our bag. Myself, I specialise predominantly in the residential investment, so buy to let basically, and commercial and semi-commercial investment side. That's my kind of strength. In terms of myself, I've been a broker for probably longer than I actually want to admit, but well over 20 years. I've been at the company for sort of like 19 years, I think it is now. So a really long time. So very experienced. I think the other thing that people quite like to know about me, which is relevant to the people watching and listening today, is that I'm a landlord myself as well. So I kind of have the experience from the broking side, but also a lot of the things that they're kind of, finding challenging and all that kind of stuff. I'm also in the same boat with them.
Good. And I like that, Jeni, because the stuff that you're able to give advice on is stuff that you see yourself. So my very first question is, when landlords start to scale their portfolio, how can diversification help make their investments more resilient?
Yeah, so I think diversification is so important, and keeping in mind that I've just mentioned I've worked at the company for 18, 19 years, so I've seen people go on real journeys. And actually, those landlords who seem to have the biggest success and real kind of resilience in what is always a challenging market, when is it not challenging? That's quite rare. These tend to be the guys who have done some kind of diversification in some way, shape, or form. And I think what is really important is when people think about diversification, rather than seeing it as a kind of growth thing, it's probably as important to look at it through the lens of risk management and resilience. That's probably kind of where it really comes into its own strength. So the kinds of things that we see landlords doing, which has had real impact for them. So first of all, geographical diversification as an example. So if you have, 20 buy-to-lets all in the same town, and that town has a major employer, and then that employer decides to leave the town, and suddenly you're faced with a load of unemployment, that could have a really big impact both on property prices, rental demand, and your tenants' abilities to pay. So having geographical diversification is really, really important in resilience. Tenant demand cycles as well. So different locations and property types will attract different types of tenants. So you can think of things here like students, professionals, families. We can think about corporate lets, housing benefits. So by having different types of tenants, you're kind of spreading your risk there and also making your portfolio more resilient and kind of protected against various changes. Different types of properties for income stability is another one that people often are kind of focusing on. So here we're kind of thinking about a single let versus an HMO, a block of flats, a holiday let, that kind of thing. Also mitigating tax risk. So by having a varied range of asset types, that can really kind of protect you if there is, for example, when Section 24 came in and they started taxing people's rents on personally held property in a certain way, that did not extend to commercial property and holiday lets. So then people would have been protected there as well. So I think in short, really having a diverse portfolio, particularly as you really scale up, really just serves to protect you and give your portfolio some real longevity against all the different kind of things that are thrown at us throughout our landlord journey.
And just on that, with releasing funds, how can landlords release funds from the portfolio to fund further investments? What advice could you give on that?
Yeah, so I think the typical way that we see a landlord scale up their portfolio, and it does tend to be a really common pattern. So someone buys a property, they obviously have to put some deposit in, but there'll be an amount of equity in that property from day one, which is the money you've put in. Over a period of years, that property grows in value. Landlord will refinance, extract the equity that they've kind of gained there, bring the loan to value back up to 75-80%, and they've got a bunch of cash, and they'll reinvest that into another one. So then they've got 2 or maybe 3, and they just keep going. So it's kind of like a reuse of equity within the portfolio. That's kind of the really typical way that we see landlords look to finance the scaling up of the portfolios. It doesn't tend to be done out of sort of earned income. People aren't sort of saving up from their day job to build up a fund. It tends to be via the portfolio itself.
The growth within however long they've held onto the asset,
Yeah.
that's then gone up to be refinanced to purchase another asset, and so on and so on.
Yeah.
And can just on the financing side of things, for say for example like a more specialist property types, can they be challenging with large portfolios?
Yeah, so I think there's a real misconception actually. So what you find is in the mortgage market, you really have 2 types of lenders, and we have our own kind of terminology. So we say vanilla lenders and specialist lenders. So vanilla lender is really, if you think about, if you walk down your high street, which banks are you going to see? So you're going to see a Santander, you'll probably see a NatWest and Nationwide, those kinds of places. They tend to be the lenders who will lend on straightforward properties to straightforward individuals or limited company structures. We then have the specialist end of the market, which are the lenders who can lend on, to limited companies, people with really large portfolios, semi-commercial HMOs, multi-units, that kind of thing. So the lending market almost kind of splits in 2. There is a bit of overlap with some lenders, but if you kind of think of it in those contexts. So in terms of challenging, if you have a large portfolio, there are lots and lots of lenders who sit in the vanilla end of the market who are very happy to lend to you as long as you have no more than 10 mortgage properties. And in anyone's kind of imagination, 10 properties is quite a large portfolio. I think the average size of portfolio in the UK is about 7.5 properties. That covers like the majority of investors. It's only when you get over 10 properties that you find that you have to start approaching the more specialist lenders. So I would say it's not actually challenging to have if you've got a larger portfolio until you get past 10. And even then it's very straightforward. It's just a different type of lender that you have to go to.
It's just a different way of doing it. Okay. And on the HMOs and your MUFBs, which is multi-unit freehold blocks for the listeners, as they're both becoming more popular, how does financing, that process and borrowing options differ from, say, your standard single let or buy to let?
Yeah, so I think the first thing is the rates are a bit more expensive. These are regarded as more of a commercial asset. So you will find that you'll pay a bit more for the privilege of having one of these. So if I was to give you a kind of difference in pricing of between 0.5% and 1%, that's kind of broadly where the cost difference comes in. In terms of lenders' risk appetite, the loan to values are the same. So you can still get 80% loan to value on an HMO or multi-unit freehold block, no problem at all. The rental calculations, the affordability calculations that sit behind the sort of key part of underwriting whether the loan is affordable in buy-to-lets, it is slightly more onerous than if you were, lending against a 2-bedroom flat, for example. Doesn't tend to be a problem because these assets tend to be more high yielding, so they can kind of cover the more onerous rental calculation, but that's just kind of worth knowing. I think one of the elements that some people come unstuck on is that some lenders say if you want to take a mortgage on an HMO or a multi-unit, we want you to have some experience of being a landlord already. So you don't come to us with your first investment and it's a 15-bedroom HMO because you simply haven't got the right experience behind you. And for those people sort of listening to this, they will be sort of nodding sagely saying, a 15-bed HMO is quite an ambitious product. It's not a case you just kind of rock up and start renting it out. There's a bit more to it. So I think, yeah. So I feel like there are lenders these days who could consider a small HMO. And in the mortgage world, a small HMO has up to 6 bedrooms, a larger HMO has more than 6 bedrooms. So there are a handful of lenders who can do small HMOs for first-time investors. But I think any actual investor out there, if we were kind of doing mentorship to new investors, we'd all be saying probably get a couple of normal buy-to-lets before you start going in for the more complex stuff, just so you can really get your head around the logistics and all that kind of stuff. But yeah, that really is the main difference. So actually the sense of applying for a mortgage on an HMO is just like applying for a mortgage on a normal buy-to-let. You really don't feel much difference at all.
Okay. And let's talk a little bit around the sort of semi-commercial properties.
Yeah.
They seem to intimidate some investors. What are the financing challenges and opportunities with these types of assets?
Yeah, so semi-commercial, and I think actually it's a term that some people find confusing. So a
Mm,
semi-commercial property is one where you have a residential element and a commercial element on the same title. Now that could be typically a shop with a flat above, all on one
mhm,
freehold.
mhm.
It could also be I don't know, a row of shops with flats above, or you can imagine, but essentially the key thing is there's residential and commercial on the same title. So generally speaking, the majority of buy-to-let lenders will not lend on semi-commercial properties. There are always very small exceptions to rules, but by and large, the minute a property has a commercial element to it, you have to go to a commercial lender. Now, in terms of the kind of challenges around financing these types of properties, what you'll find is there are less lenders doing semi-commercial mortgages, therefore there's less choice.
Mhm.
You will find that some lenders are quite picky about the kind of commercial element to the building. So some
Mm.
might say, we don't mind if there's an office as the commercial parts, but we don't want to, and if it's a takeaway, for example.
Yep.
Or if you think about the kinds of businesses which are really struggling at the moment, so you may find that lenders are less reticent to take on a commercial element to a building if the tenant in that part falls into one of those sort of areas which is struggling, because actually there's a risk that tenant won't be able to pay you the rent, and
Mm.
therefore you kind of come unstuck. So it's all about sort of putting your underwriting hat on when thinking about it.
Mm.
But actually, there are lots and lots of landlords diversifying, kind of thinking about other options at the moment. We're seeing a definite uptake in the number of landlords looking at semi-commercial, the kinds of terms available. So 75% loan to value is available. You can still do interest only. Ideally, you'll have a bit of experience, kind of like the HMOs, just because it's something a bit different. But I would say absolutely, it's nothing to be afraid of. And actually, there are some real positives with having a commercial element to the building. For example, these tend to be on long leases, so you haven't got a tenant, well, particularly with the Renters' Rights Act coming in, and actually even the 6 month surety of a tenancy kind of goes. This would be a
Mhm.
5 year lease, so therefore you can kind of largely forget about the commercial element for 5 years.
Mm.
So it spreads the income on the property. Things have to be kind of handed back to you in the condition that they were given over in the first place. There's a lot of protections there. So actually, I think they're definitely something that people are becoming more open to, and I think they'll really benefit from maybe considering having one of these in their portfolio.
And are there lenders that specialize in these sort of non-standard asset types? And how can a broker help navigate that area?
Yeah, that's a really good question. So yes, there are lenders who are definitely more specialists. So, for example, if you rocked up to your local Santander branch and had an appointment with their mortgage advisor, they're not going to be able to give you a mortgage on a semi-commercial. So it is definitely more specialist. There was, after the credit crisis, a real kind of space in the market for commercial lending, semi-commercial commercial lending, because a lot of the kind of high street lenders really stepped away from that market. And then the door kind of opened, and we had the kind of the first lender who really came in at the time was Aldermore Bank. Then we had Shawbrook. Then people probably would have heard of Interbay. So you started seeing a kind of new wave of lenders coming in, and actually now there's a really good community of lenders who are non-high street lenders who specialize in semi-commercial and commercial lending as well. So it is a definite type of lender you'd want to approach for these kinds of things. I mean, in terms of using a broker, obviously I'm going to say that it's the best thing to do, because it really enhances the service, because I have a vested interest. But I do generally think actually when you're moving more into the specialist end of the market, when you're dealing with something that you're used to, we can add some real value. So we will find you the right lender. We know how to structure the case so it looks good to an underwriter. We know how to really advocate for you with
Mm.
the underwriters. We understand how the valuations work. We know the paperwork they're going to be looking for. We know the kind of wording that lenders are looking for in terms of when you're presenting things like strategy. So we can really kind of make sure you go to the right lender, and then ensure that the kind of end-to-end process of that application goes as smoothly as it possibly can.
Okay. And I just want to talk about a little bit around strategy, around what mistakes do you commonly see landlords make when they diversify too quickly or without a strategy?
Yes, I think it's really interesting, that one, because a lot of landlords are a person investing money in property, probably for a pension. That tends to be where most people's heads are starting with this. So they're just not thinking about things like strategy because they're just not a corporate kind of thing. It's just a person doing a bit of investing. And so actually, when they start to scale up, we do often see people going quite quickly and not really understanding what their end game is and how they want things to look. So the common mistakes I would see. So the first one would be really chasing yields without understanding the risk. So those people who are like, right, I'm going to buy, a 15-bed HMO, going to rent it to students, which is a great yield generating opportunity. But do you really understand the risks and the kind of challenges that come with that? Another one that we can see people particularly struggle with is when they over leverage their portfolios. This is going back to where we originally started saying about refinancing your portfolio, taking money out and reinvesting it. Some people have a portfolio of many properties and you look across it and they're leveraged to the maximum across the whole thing. That can be not great if property prices come down because you can be sort of teetering on no equity or even negative equity fairly rapidly if the market tanks. The other thing is that actually when lenders are assessing background portfolios, they don't want to see things really aggressively leveraged. They do want to see that you've got some headroom in there as well. I think also just what people can often do is they ignore what we would class as operational complexity. And what that really means is that different properties and different asset types will come with different kinds of regulation and rules that sit around them, and often people don't necessarily appreciate how complex that can be. And so sometimes people will fall foul of kind of rules unintentionally, and that can be a bit of a kind of problem for them down the line. It often ends up costing them money and fines and stuff. So really just kind of taking time to sit back and really research the market that you're going into, just to make sure that you totally have everything in the right place so you don't sort of have any issues down the line.
Okay, and let's just ask a little bit about, the start of the call we said about growth and stuff for the portfolio. So for landlords wanting to grow, what are the main ways to release equity from existing properties?
Yeah, it's a really good question. So, as you kind of alluded to, remortgaging your property and taking money out is definitely like the most common way of doing this. So that's kind of number one. Another option, which we will always look at on behalf of our clients, is approaching existing lenders and saying, actually, rather than remortgaging the whole thing and potentially incurring early repayment charges, if that's where you are in terms of your existing arrangements, could we just get a top-up loan from the existing lender? So that can be another option. That can work out to be quite a competitive way, cost competitive way of doing things. Another option could be second charges. So say, for example, you've got a mortgage at the moment, you're on some, absolutely wizard low interest rate. You don't want to disrupt that. The existing lender says, no, I'm not going to give you a top-up loan. It could be that then you could look at a second charge loan to sit behind the one that you've currently got without disrupting that. They can be quite useful at times. Portfolio loans is another one that we're seeing more and more sort of larger portfolio landlords particularly consider. This is where you take a single loan and secure it across all of your portfolio or a chunk of your portfolio. Benefits here are one mortgage. It's easy to kind of keep track of. It's one mortgage payment, a lot less paperwork, and some people really go in for that. And the other thing with those is that what the lender would do is, if, for example, they were thinking, well, hang on a minute, this property here is really low performing on yield, but this one over here is really high, it means they will blend the income across the two so that you can still leverage across the whole thing on the values. That can be really good. Another thing which I think people don't like talking about at the moment, because no one really wants to talk the market down too much, but we are definitely seeing a notable shift in terms of investors really kind of auditing their portfolios at the moment and saying, well, this one's going to cost me an absolute fortune when I have to do the changes for the imminent EPC changes. This one's yield is rubbish. So actually, I'm going to sell a couple off, get some money, and then go back and reinvest with the kind of like present time situation. Yeah, and
It's
I
not a
don't
bad
think we.
strategy.
Yeah, it's not to be, people I think don't like talking about it, but I actually think there's a lot to be said for consolidation. You've done well out of the property over the last 10 years. Maybe the time is to sell that particular asset and go again with something that's more relevant in the current climate.
I like that. And with landlords as landlords expand into more specialized properties, how
Yeah.
important is it to structure their borrowing in a way that supports long-term diversification?
Yeah, I think that is really useful. What you can find is people are always kind of borrowing for the moment. So right now, I'm going to do a remortgage. I don't have an imminent acquisition lined up, therefore I'm just going to take, this amount of money right now because that's all I need. And then 3 months later, they're back to us saying, "Oh, I found this really good property that I want to buy now. I need to get some money out of this property. How can I do that?" And it's like, we've just locked yourself into a 5-year fixed rate. So this is going to be quite tricky. So I think actually just having, and it comes back to that sense of strategy, really having a view. I think it's really important for landlords to at least consider, as a minimum, the next 12 months. You can do the kind of bigger stuff as well, and that's also really, really important, but just kind of having a fairly structured view on what your plans are for the next 12 months so you can really shape financing around that. I think it would also be remiss of me not to kind of talk about estate planning, and that's something we're definitely seeing more people thinking about. This is like the opposite, which is like right into the future, the bit that no one likes to think about, which is the bit when we die. But actually what we're seeing is a real increase with the number of landlords who have limited companies now.
Yep.
The first stage was actually just using a limited company. That was a big kind of shift for people, but actually now people are thinking, well, hang on a minute, I've got this limited company, I can do some really nice stuff in terms of estate planning. And so we're seeing a real kind of trend towards landlords having, structures where not only do they have the properties in their companies, but they're actually starting to look at share ownership in, with the plans of being tax efficient in giving things over to their kids, or, the cat charity or whatever it is you want to give your money to when you do eventually pass away.
And my last question, which I think is probably my favorite question of them all, is if you had one piece of advice for landlords to help them be financially ready for their next purchase, what would it be?
Yeah, I think it really is to just be very holistic in how you're planning things. So um, when you're looking at financing, always know the capabilities of your portfolio. So actually, rather than just thinking about this, rate that's ending right now and what am I going to do with this one, be kind of really thinking about actually, if I've got lots of capital in this property, do I want to make it work harder? If it's in the property, it's not doing a huge amount for me. Could I be unlocking that, realizing that capital and investing it and making it, much more profitable for me? That would be my real thing. So just keeping in mind of the overall potential of what you have there.
Jeni, thank you so much for coming on the show and taking the time out to help, educate landlords on the platform. So I really, really appreciate it. And
Thank you.
thank you so much.
Pleasure.